Hey guys, so we're going over the bank balance sheet practice that is in your monetary policy packet. So you already have this packet. We've been working on it for a few days now. So flip maybe 3, 4, 5 pages in, and you're going to see a paper that looks like this. Yours won't have this table on it that I added. It'll be blank. But what I want you to do is I want you to make T-charts. So for every question, you're making a T-chart. So on one side, we have assets, and on the other side, we have liabilities. So an asset is anything that the bank can quickly liquidate and turn into cash. So obviously, if they loan out any money, they can always ask for that money back and bam, they can have cash. Any property that they have is also going to be an asset because they can sell it. So like think of the last time you were at the bank, they had furniture there and computers. They can easily sell those things and convert it into cash just in case they were going out of business or something like that. A liability, on the other hand, is any money that the bank owes someone else. They are indebted, so they need or they're in debt. They obviously deposits are going to be here because if I bank at Chase, so if I can go anytime to Chase and withdraw my money. It's money that I've deposited there, but that's the money that they owe me. If I go to an ATM, they have to give me my money back. So it's money that they owe me. That's a huge liability on their end. So we got assets, money that can quickly be converted into cash that the bank has, that's an asset for them, versus a liability is money that they owe elsewhere. It's money that they have right now, but if anyone was to ask for it back, they're going to have to pay that money back. Okay, so I made a little table, but I want you guys to make a T-chart. It's just a whole lot easier to make a table on a Word document than it is a T-chart. But you guys don't have it in a Word document. You have a hard copy. So follow along with a T-chart. So a bank decides to open as a startup with the following. They sell stock ownership in the bank and receive 250K of capital stock. Okay, so basically the bank is selling stock for the bank, like they are selling portions of the company off. And so like if one person buys this $250,000 stock, they're the only shareholder. Of course, that's going to be on the liability side, just because we owe that stockholder money. So whether that is split into just one share of one $250,000 share stock, or this is multiple, we still owe our stockholders that money. So what I like to do is I like to figure out which column it's going to go in, and I make sure that I label what that transaction is, so I don't forget later on down the road. Of course, they spend $200,000 on property and a building and equipment. So that's going to be an asset of property. If they were to go under, they can quickly sell that land, quickly sell that building, all the equipment in it, and it turns into cash, $200,000 cash. And so what I'm going to do here is put that on the asset side and just label that property. Okay, here's the thing. These are called bank balance sheets. And if you remember when we did balance of payments transaction with the financial account and the capital and current and all of the, they balanced out. Same thing with a bank balance sheet. They will always balance each other out. This, we got $200,000 on one side and $250,000 on the other. That is a balance. So anytime that they don't have a balance, you're going to make sure that whatever it takes to balance needs to happen. So on the asset side, we're going to have excess reserves of $50,000. Okay, let me just explain what's really happening here. The bank has a whole bunch of shareholders that gave them $250,000, and with that money, they spent $200,000 on property and had $50,000 left over. So for a total of, they received $250,000 and they spent $200,000, and they have $50,000 of an excess reserves, an extra money that they haven't spent. Does this equal so far? 200 plus 50 is 250, and 250 on this side, so they both equal. So we're good here. Okay, so let's look at letter C. the bank receives a deposit of $100,000 from their first customer. The RRR is 10%. Okay, so the transactions from the question number 1 haven't changed. So here we go. What I'm going to ask myself is what has changed and what hasn't. Okay, on the asset side, does it have anything to do with property? Did they sell property? Did they gain property? No. So it's still going to be $200,000 still on property. Nothing happened to the stock, so we're just keeping that the same. $250,000 in stock. Not stock. Okay, we're always going to keep excess reserves. That's the balancing. We're going to keep that to our last transaction that we do because that's going to be our balancing agent. So that's going to be the thing that we're really going to change almost every single problem that we have. So we're going to say that for the very last. We always write down the things that didn't change at all. First, stock didn't change. Property didn't change. But what did change is the bank receives a deposit of $100,000. Okay, $100,000 deposit, that's going to be a liability because that customer is going to, at some point, can withdraw all $100,000. So I'm going to put $100,000 in the deposit side on the liabilities. Okay, of course, it made a note to say that the reserve requirement ratio is 10%. That's going to be an asset because that's money that is in the bank at all times. That cannot be loaned out. It's the bank's money now, and so for required reserves, let's just do RR for required reserves, is going to be 10%. So it's going to be 10% of whatever the deposits are. It's not going to be 10% of what is in the liabilities column. It's going to be 10% of total deposits because that is the definition of the required reserves. And so 10% of $100,000 is $10,000. And whatever is left over is going to be in the required reserves. So we had $50,000 left over from before. $50,000 is what we never spent from that stock. And now, since we have a whole bunch of deposits, only $10,000 of it's in required reserves, but whatever's left over is in excess. So we had $50,000 before. We have $100,000 minus 10 added to it, so in total 90,000 plus the 50,000, so it's going to be $140,000. Okay, another way you can figure this out is, well, if this is the liability side equals the $350,000, what does excess reserves have to be for the assets side to also be equal to $350,000? So it had to be 140 because we had 200 plus 10, so 210. 210 plus 140, yeah, that's going to give you that 350 that we need for it to be in balance. Okay, let's look at letter D. Let me get rid of these spaces. Okay, the bank lends out as much as possible and are said to be fully loaned up. Okay, so let's see what has changed and what hasn't changed. Property, 200,000, hasn't changed. I can just type correctly. Oh my goodness. 200,000 hasn't changed. Property. 250,000. I'm going to abbreviate here. 250,000 of stock hasn't changed. They lend out as much as possible are said to be fully loaned up. So deposits, once again, hasn't changed. 100,000. Let's do 100K. Deposits that has not changed. Excess reserves. We're going to say that for last, but required reserves, what's required to be kept in the bank is always still the same thing. It's 10% in this case, because that was in our problem before, is 10% of total deposits. Total deposits haven't changed, so required reserves cannot change. So it's still going to be $10,000 because that's 10% of 100. Okay, so it looks like everything that hasn't changed we have brought down. We've kind of clicked, copied, and pasted. If we can't misspell deposits, click that. There we go. But they lend out as much as possible. Well, how much can they lend out? How much can this bank lend out? let's see here. They sold stock. There's a whole bunch of deposits. Here's property that they bought with that stock. Here's what they cannot touch. But here's excess. Excess, they can loan out all of their excess reserves, but they can't loan out the required reserves because that's required to stay in. But they can loan out what is excess. So that $140,000 is now changed to a loan. And notice how I'm keeping it out into the asset side and not switching to liabilities, because that bank can call those people back and be like, hey, remember how I loaned you $140,000? Yeah, you need to pay us back. So that's why it's a liability, because they can quickly turn those loans to customers into assets for themselves. That's money that someone owes them, not them owing someone else. And so they loaned up everything, which means our excess reserves is zero. There's nothing in excess. We loaned it all out. And still we have $350,000 on the liability side. If we add up 200 plus 10 plus 140 plus 0, you're still going to get 350. So we're good and we're balanced. So let's keep on going. Letter E. Let me get rid of some spaces here. Letter E. The customer who deposited $100,000 writes a check for $50,000. The bank decides to borrow $100,000 from the Fed rather than calling us loans. Then they can clear the check. Okay, here's the thing. If we go back here, it says that there's nothing in excess reserves. And the very next day, the customer who had that $100,000 deposit is asking for $50,000 back. Maybe they're buying a car or something. Well, we just loaned out all their money. So how are we possibly going to give them their $50,000? I mean, it's their money. They have to get it if they ask for it back. So that's why this bank is borrowing money from the Fed. Typically, they wouldn't do that. They would just borrow money from a different bank. But this is just a silly worksheet for practice. So we're going to say that they're borrowing money from the Fed. Okay, so they're borrowing money from the Fed so they can give that customer their deposit back. Okay, so what has changed? What hasn't changed? So property, still $200K property, has not changed. $250,000 of stock, hasn't changed. Oh my gosh, I can't spell stock. Going back, you know what? We're not going to put reserve requirements on here just yet because I noticed that they're going to change the deposits here on letter E. They're changing the deposits. So we're going to be changing our required reserves as well. Okay, so, but let's bring down that loan. Let's basically copy and paste that $140,000 loan. That's still on the asset side. Okay, so everything that has not changed, we brought down, but let's talk about what has changed. The customer who deposited $100,000 writes a check for $50,000. So what's left is $50,000 in deposits. If I can write deposits, wow, okay. Of course, that's going to change our required reserves. So it's still going to be 10% like it was way up here on letter C. It's still going to be 10%. But we are going to make sure it's 10% of the total deposits. Not $100,000 this time, it's $50,000. So 10% is going to be $5,000. $5,000 in required reserves. Okay. Let's do something about excess reserves here. Let's keep that open because we don't know what it's going to be. But the bank decides to borrow $100,000 from the Fed. Okay, if they borrow money from the Fed, now they're the ones taking in a loan. That's a huge liability. The Fed can always call that money in. So this $100,000 from the Fed is going to be on the liability side. So I'm going to say loan from Fed. So I remember. Okay, we're not even here. We have 250 plus 50 plus 100,000 for a total of, well, that's going to be 350, 400. This doesn't add up to 400. So let's see here what the excess reserves have to be. So if, let's see here. I'm trying to do some simple math. Okay, so 250 plus 100 is 350 plus 50 is 400. So 400 minus 200 is 200 minus 140. Is this just a simple, am I doing this right? I'm gonna have to bring out my calculator. I did this earlier, but I think I missed a couple of zeros when I was doing it in my head earlier. Okay, so 250 plus 50 plus 100,000. Well, now I have a Matthew running around in the background. 250, 350, 4. Okay, so 400 minus 200. I can't believe I have to do this on a calculator. Minus 5. 55. Excess reserves of 55,000. Wow. Those of you that figure that out before I do, good for you. You should make more money than I do. Okay, so if my math is correct, 200, and let me make sure that it is 200,000 property plus 140 for the loan plus 5 in required reserves plus 55 in excess reserves is going to give you that $400,000. Wow, I really messed that up before. Did I drag everything right? I guess I did. Okay, so let's scroll on down. The bank receives $200,000 from a new customer. Okay, so what do you do? Once again, you always drag down the stuff that did not change. Okay, so property didn't change. $200,000 in property. $250,000 in stock for a liability. Let's see here, that loan, yeah, they receive a $200,000 from a new customer. That's not anything to do with a loan. So we got to bring down that $140,000, $140,000 loan. And we took out, remember, $100,000 loan from the Fed. Loan from Fed. Okay, that seems to be, because we're changing deposits here. Someone is, the bank receives $200,000. So we're going to be changing deposits, which means we're going to be changing required reserves and excess reserves. So everything that has not changed, we have brought down. So let's now talk about the stuff that has changed. We had $50,000 in deposits before, and now they're depositing $200,000. So we have $250,000 of deposits. Okay, don't feel like you need to have those deposits separated. Like one customer cannot intermingle their money with another customer. That's not how a bank works. All the money goes into like the oh my goodness, the teller's drawer. I used to be a teller, I should remember this. It goes in the teller's drawer, and all that entire drawer goes into the vault. So it's all together, so you don't need to keep them separate. But since we changed our deposits, we need to change our required reserves. Required reserves is going to be 10% at $250,000, which is $25,000. And excess reserves. And since I messed up on my numbers last time, my numbers are not going to be able to do it in my head. So 250 plus 250 is 500,000, plus 100 is going to be 600,000. So we need to make sure that the asset side are also going to be 600,000. So we have $200,000 in property. And what I'm basically going to do is, instead of adding and then subtracting, I'm going to, if I can get my calculator open, I'm going to do 600 and then minus 200 of property, minus 140 for the loan, minus $25,000 in excess reserves for a grand total of $235,000 must be left over in excess reserves. Okay, so we have these two now equal for 600,000. And let's do letter D. The bank decides to diversify and buy $150,000 in bonds from the Fed. Okay, this is the great thing about bank balance sheets. They're easy, but they're just monotonous. So, yay, $200,000 in property. That didn't change. $250,000 in stock. Let me put a K next to that so we remember that's thousands. What also hasn't changed is that $140,000 in loan. It didn't say anything about deposits or loans from the Fed, so That's still the same. How much did we borrow from the Fed? We borrowed $100,000 from the Fed. So $100,000 loan from the Fed. We still have $250,000 in deposits, which means, if I can write, which means that we have still the required reserves is still okay, 10% of that. So $25,000. Excess reserves is always going to be one of our last things that we do. The bank decides to diversify and buy $150,000 in bonds from the Fed. Okay, where are they getting this money to buy bonds from the Fed? Well, they're getting it from their excess reserves. We have $235,000 of excess reserves. They're just subtracting $150,000 of it, and just that's going to be an asset for them. A bond, the Fed owes them money with interest, so that's a huge asset for them. So it's going to be bond from the Fed. And excess reserves is going to be whatever's left over, so $85,000. Because that's 235 minus 150, and that should be 85. If my Texas Tech math serves me well, 235 minus 150 is 85. Man, how awesome. Okay, and last but not least, let's do letter H. Here are some spaces. Letter H, the customer who borrowed $100,000 pays off his loan. Okay, this is going to be an easy one because very little has changed. $200,000 in property remains the same. $250,000 in stock remains the same. Stock. Let's do the $100,000 loan from Fed. Stays the same. Even that $250,000 deposits stays the same, which means our required reserves are still going to be, wow, if I can misspell deposits one more time, that'd be great. My required reserves is still going to be 10% of 25,000 or 250,000, so that's 25,000. My bond from the Fed is still 150,000. You see that I'm just dragging down things that haven't changed. Okay, but the customer who borrowed $100,000 pays off his loan. We had $140,000 in loans, and $100,000 are going to be paid off, which means we still have some amount of loans. We still have $40,000 in loans. But the person that paid off their $100,000 of it, well, all that money is just extra money. They paid it off. It doesn't go back into their bank account. It doesn't go back into anyone's bank account. It's just extra money that we have. And any extra money is excess reserves. So excess reserves is going to go up by 100,000. So we have 185,000 in excess reserves. And if we do our math right, we still should have $600,000 in assets and $600,000 in liabilities because it's the bank balance sheets. So on the liability side, 250 plus 250 is 500 plus 100 is 600. Making sure that the math right on the other side. Once again, I'm going to get my calculator out because my brain is slow. 200 plus 25 plus 150 plus 40 plus 185, grand total of $600,000. So everything is neat and tidy. Assets, remember, is money that the bank has and could call back at any time, whether it's property that they sell, a bond from the Fed that they're going to get that money back plus interest, loans that they gave out to customers, or any just extra rainy day money. Liability is any money that they owe people, whether it's money that they owe their stockholders, money that they borrowed from the Fed, or the customers that deposited their money there. So hopefully this wasn't too confusing. It's a little monotonous, I'll give you that. But that right there is bank balance sheet practice. Thanks.